Welcome back to the Deep Dive. Today, we are opening up the engine room of the economy. We're going to put the UK financial system under the microscope. And specifically, we want to focus on the specialized roles of the institutions that are constantly processing, well, trillions of pounds. Our mission today is really to cut through the jargon. We want to unpack the specific, distinct jobs done by the core players, retail banks, building societies, and insurance companies. We need to understand not just what they do, but how their very different business models fit together to create the system's backbone.
That structural view is absolutely key. At their heart, these organizations are sophisticated matchmakers. They are the crucial intermediaries connecting those with surplus funds, everyday savers like you and me, with those who need capital. It could be businesses looking to expand or individuals needing a mortgage. And the value they add is just immense. They take these scattered savings, pool them, and make sure money circulates efficiently. They maintain liquidity so the whole system doesn't just grind to a halt, and they channel capital towards, well, productive uses. Essentially, they transform individual trust into systemic stability and safety.
Yeah, without that specialization, that trust you mentioned, the cost of funding anything would just be sky high. Okay, let's unpack these key players then. And let's start with the institution we all interact with pretty much daily. The cornerstone, retail banks. Retail banks are like the front line, aren't they? Providing all the essential stuff. Current accounts, savings loans, mortgages, payment systems.
Yeah, exactly.
Their fundamental business, as our sources highlight, is deposit taking and lending. But the real core of their function is this concept known as maturity transformation. Can you unpack that a bit?
Yeah, absolutely. Maturity transformation is really how a bank creates economic velocity. It's this pretty sophisticated process. They take short-term liabilities, that's the money you and I deposit, which we can, potentially withdraw tomorrow.
Right, instant access mostly.
Precisely.
Huh.
And they transform that into long-term assets. Think primarily mortgages and corporate loans, things that might last 25 or even 30 years. And they profit from the difference, the interest rate spread between what they pay savers and what they charge borrowers. It's the engine of liquidity, definitely, but it's also the source of their biggest risk.
That's what I find so interesting and honestly a little bit nerve-wracking. A bank is essentially running this controlled risk, right? They're kind of betting that these short-term funds won't all disappear at once while those long-term loans are locked in. It's a constant tightrope walk between trying to make a profit that margin and having to be incredibly prudent.
That's it, exactly. They have to maintain enough capital buffer to absorb unexpected losses. And they need to manage liquidity really, really rigorously so they can meet immediate demands, especially during, times of stress. That's why, particularly after the 2008 financial crisis, the whole regulatory environment got significantly stricter.
That makes sense.
So now you basically see two main regulatory watchdogs overseeing them. There's the PRA, the Prudential Regulation Authority. Their job is monitoring the bank's overall financial soundness, making sure they have enough capital to withstand shocks.
Okay, the stability side.
Yeah. And then you have the SCA, the Financial Conduct Authority. They're focused squarely on market conduct, ensuring outcomes for you, the customer, are fair and transparent.
Got it. So PRA bank doesn't collapse. FCA bank treats me fairly. That distinction is really helpful. But here's where it gets, I think, really interesting. Because not all institutions that take deposits are structured like those big shareholder-driven banks we just talked about. Let's transition to building societies. How do they fit in?
Yes. The distinction here is absolutely fundamental. Building societies operate on what's called the mutual model. This means they are owned by their members. And the members are the savers and the borrowers. There are no external shareholders demanding, ever-increasing quarterly profits.
Right. No shares trading on the stock exchange demanding dividends.
Exactly. And this changes the entire decision-making philosophy. While big bank might be looking at, global trading or complex derivatives to boost shareholder returns, building societies are structurally focused primarily on providing savings and mortgages at competitive rates to their members, often with a really strong emphasis on community-based lending.
That's the key difference, isn't it? If their main goal isn't maximizing profit for external shareholders, how does that actually change their day-to-day decisions, like setting interest rates or deciding who gets loans?
Well, it allows them to prioritize sort of stability and long-term value for the members. They can choose to reinvest profits directly back into the society itself. So that could mean offering slightly better interest rates on savings, maybe lower rates on mortgages, or even supporting local community initiatives. They're not siphoning that capital off for external dividend payments. It gives them a very different feel, a different orientation.
So In theory, they're more sheltered from the sort of short-term pressures of the stock market, but I assume they're still held to the exact same high standards of prudence and regulation as the big banks.
Oh, absolutely, without question. Our sources confirm they face the same stringent regulatory expectations. Capital adequacy, customer protection, all of it. The system demands competence and resilience, regardless of whether your owners are shareholders down the road or members living in the community.
Okay, that makes sense. Right, let's pivot to the third critical pillar. Insurance firms. These guys play an equally vital but kind of dual role in the economy, right? It extends well beyond just holding deposits or lending for homes. First, and perhaps most obviously, they are the economy's risk managers.
Yes, that's the first big role. Providing financial protection. It's classic risk management, really.
Yeah.
They pull premiums from thousands, millions of policyholders, whether it's life insurance, your house insurance, car insurance, income protection. And the idea is to ensure that the financial burden of a loss falls on the collective pool, not just crushes the individual who suffers the misfortune. They effectively spread or diversify risk across the whole economy.
It's just powerful enough in itself. But their second role is arguably even more impactful on the macro economy. They're these huge institutional players with incredibly long-term liabilities.
Exactly.
Yeah.
Especially life insurers. They are fundamental long-term institutional investors. Think about it.
Yeah.
They collect premium income today, but they might not need to pay out the associated claims for, 30, 40, maybe even 50 years?
Wow, yeah.
So they have this enormous pool of very long-term capital that has to be put to work somehow. It can't just sit there. And they use this capital to invest heavily in long-duration assets. We're talking government bonds, big infrastructure projects, equities in companies, large commercial property developments. They deploy capital that directly funds national growth while also generating the kind of returns they need to be sure they can meet those future commitments, those claims down the line.
Right, because their time horizon is so distant. Their regulation must be incredibly focused on guaranteeing those future payouts decades from now.
Absolutely. They have to maintain substantial solvency margins.
Yeah.
For the listener, this is basically a safety cushion, a rule book saying how much extra capital insurance companies must hold just to guarantee future claims can be paid.
Yeah.
In the UK and Europe, this is largely governed by the Solvency II framework. The regulator needs, near certainty that today's premiums will be enough to cover tomorrow's potential claims, even big ones.
Okay, so we've kind of established these three core functions then. We have banks performing maturity transformation, ensuring liquidity. We have building societies using the mutual model, often with a community focus. And then insurers managing risk and acting as these crucial long-term capital deployers. So what does this all mean when we sort of connect the dots? How does this massive, diverse system actually maintain its integrity?
Well, it holds together through shared principles of rigorous risk management and good governance. And if we think about the wider financial ecosystem, we haven't even talked much about investment firms, pension providers, financial advisors. They all share key responsibilities. They all must manage critical risks. Take credit risk, the chance a borrower won't pay back their loan. That's obviously huge for a retail bank writing mortgages.
Sure.
But it's also a factor for an insurer holding corporate bonds in its investment portfolio. Then there's liquidity risk, having enough cash on hand. Existential for a bank, as we said. Maybe less immediately critical for a life insurer with decades before a claim is due.
Right, different pressures.
Exactly. Market risk, the risk that investments fall in a value, that's huge for institutional investors, like insurers. Maybe less so for a typical building society focused on simple mortgages.
So the specific types of risk might be weighted differently depending on the business model, but that collective obligation, the duty to manage risk responsibly, that's universal across the board.
Correct. And the ultimate safeguard really is strong governance. You need independent boards asking tough questions, transparent reporting so everyone knows what's going on, and robust internal controls and compliance functions. That whole framework is what builds and maintains confidence across the entire system.
Which brings us neatly to the bigger picture, doesn't it? When these three diverse types of institutions, banks, societies, insurers, successfully do their unique jobs. They ensure liquidity flows, they provide that financial safety net through insurance, and they deploy that vital long-term capital. This combined effort, it seems, is what underpins growth, stability, and prosperity for the whole economy.
Absolutely. And the flip side is just as important. Failure in any single part, whether it's down to poor governance, taking way too much risk, or even just a major internal operational mess-up, it doesn't tend to stay contained, does it? It ripples outwards. It undermines consumer trust. And once that trust is damaged, those capital flows the economy absolutely relies on can just, well, dry up almost instantly.
Yeah, that collective responsibility really feels like the ultimate takeaway here. We've seen how these three core institutional models perform quite different functions: that maturity transformation in banks, the mutual ownership in societies, and the dual investing role of insurers.
And understanding these specific, highly regulated roles is, I think, essential if you want to grasp how financial advice fits into the wider system. And crucially, how public confidence is maintained or sometimes lost day to day. It really is a finely tuned machine, or at least it aims to be.
It certainly aims to be. We've seen how regulated they are, and we've touched on the typical risks they manage: credit, liquidity, operational, market risk. But here's something maybe for you, the listener, to consider as you digest all this. The financial system's success clearly relies on every single institution upholding high standards of competence and ethics. We know the risks that are written down in the regulatory rulebooks, but what hidden pressure points, maybe external shocks, geopolitical shifts, or rapid technological change, might test that collective integrity next? How could those pressures impact that sometimes fragile balance we've been discussing?
That's a fascinating and pretty critical thought to leave our listeners chewing on.
Indeed. Until the next deep dive, thanks for joining us.